Mutual fund experts advise investors to avoid panic and stay invested in large cap funds and keep a multi-asset approach, which means a mix of equity, fixed income instruments and some exposure to gold at a time when India is in between geopolitically tense situations. Now reacting to Operation Sindoor, a strike by Indian armed forces on 9 terror hubs in Pakistan and POK on the midnight of May 7, the benchmark stock markets shook off with jitters but had remained overall steady. As per studies by experts, historical data seems to show that whenever such skirmishes have happened between India and Pakistan, it has had very short-term impacts on the equity market, which means over longer periods, which is after 6 months to a year, there is very minimal impact. During previous conflicts like the Kargil of 1999, Parliament attack 2001, surgical strikes 2016 and Balakot 2019, markets initially demonstrated volatility before stabilizing. The typical correction range between 5 to 10%, followed by recovery periods spanning from 2 to 6 months depending on the conflict intensity. So market experts have suggested that investors can be more skewed towards the large caps, as historically they have performed better in such situations, and avoid mid and small cap companies because they continue to be overvalued despite the corrections. Investors can also look at multi-asset allocation funds where one can get exposure to debt, which includes the fixed income securities, particularly sovereign bonds, high-quality corporate debt and gold alongside equity. Gold has the potential to outperform in uncertain times, though some volatility can be expected in the near term in gold. So a 5 to 10% allocation to gold is advised at this time. For SIPs, flexi-cap funds will be apt products for investors, which can help you give a diversified approach, as these funds allow you to shift investment based on market trends and adjust between the large, mid and small caps. Now that was with respect to allocation. What are the major triggers that investors must keep an eye out for, apart from Pakistan's response to the ongoing conflict? Firstly, statements from major powers like US, China and Russia, which could influence the market sentiment significantly. Second, foreign portfolio investor behavior during the first 10 days following military actions, as it can establish medium-term trends. Any announcements regarding increased defense allocations that could impact the fiscal deficit projections, potentially influencing the interest rate trajectories, and bond yields must be watched out for. Additionally, investors must keep an eye on oil prices, and lastly, the US tariff implications. Now, some experts have also suggested that sensing opportunity in these uncertain times, any corrections or volatility in the market should be used as an opportunity to invest and benefit from buying good businesses at lower prices and better valuations. Some sectors that could potentially see an uptick are defense in the current situation, also pharmaceutical and FMCG sectors, as their demands remain inelastic regardless of geopolitical developments. Most experts believe in the India growth story in the long term due to strong fundamentals, while some volatility is expected in the short term. Lastly, as we know that no one can really time events, and the best way to navigate such times is to stay put, check your asset allocation, and invest incrementally in a phased manner.
If you like the video, do like, comment, share and subscribe.